This is Terms of Reference Podcast number 157.
Instead of going to the government and asking for a solution, we went with a solution, not with a problem. And so when you do that, what we discovered is people, regardless whether they agree or disagree, you've got something in front of them they have to react to. And with that reaction, whether it's positive or negative, you become a conversation, and then you have a chance to further the conversation with data and information and facts.
This is Terms of Reference. I'm your host, Stephen Laddick. If there's any one question I get asked more than any other from professionals in the social sector, it's some variation of this. How do I raise money for my organization, cause, or program? And then there's usually a quick follow-up to that goes something like, and how do I raise money sustainably? Fundraising, marketing, business development, sales, call it what you want. These will always be the greatest problem for the social sector. And the reason I know this is because it remains the greatest problem for any business, regardless of the sector. Getting individuals to part with their hard-earned cash is never an easy prospect, whether you're talking about a new pair of shoes, supporting Syrian refugees, or anything in between. There are many good answers to this question, of course, but of course they're depending on a number of different factors. And there are actually a ton of fantastic success stories in the social sector. But today's episode is focused on crowdfunding and how this powerful platform can be used as a part of a successful strategy within the social sector. My guest for the 157th Terms of Reference podcast, Jason Best, is more than an expert on raising money. He actually is one of the original authors of what eventually became the Jobs Act in the United States, a law that fundamentally changed the investment landscape by allowing crowdfunding for equity, or an ownership stake in a company. Jason is a co-founder of Crowdfund Capital Advisors and a venture partner at Vector Ventures. He works with governments and policymakers about how to make online fundraising available. He works with financial technology innovators about how to create solutions that respond to opportunities created by new policies and regulations. And he also works with large institutions and corporations to understand the market shift brought about by crowdfunding. This is a guy that you want to listen to. And I think this is an important episode overall because Jason and I not only talk about the 460-day campaign to get the Jobs Act signed into law, but we also talk about how crowdfunding has fundamentally shifted how the social sector should think about fundraising now and for the future. I spoke with Jason in Hong Kong. But before we get started, here's a quick word from our sponsor.
The Terms of Reference podcast is sponsored by International Solutions Group, helping to improve the social impact of governments, UN agencies, NGOs, and companies for more than 10 years. Visit ISG online at www.theisg.com.
Hello, Jason. Thank you so much for being on the Terms of Reference podcast today.
Thanks, Stephen. Great to be here.
Jason, we were joking before we started this interview that you're a world traveler. I know that, you have an office in Hong Kong. You, I think, live in San Francisco, but you probably are doing a deal in London right now. Where do we find you?
Yeah, my friends usually joke that I'm actually based on American Airlines.
I'm
not
sure if that's a dig or a compliment.
I think it's more of a dig. But anyway, so today I'm in Hong Kong, working with my friends at Vector Ventures. I'm a venture partner here at Vector Ventures when I'm not working on crowdfunding policy work.
Oh, excellent. So this is great. I think you're the first person I think we've talked to who's actually been sitting in Hong Kong, which is fantastic. It's always nice to have a new location. But
Sure.
As you said, you're the co-founder of an organization called Crowdfund Capital Advisors. You're also a venture partner at Vector Ventures in Hong Kong. And you and I met a couple of months ago here in Bangkok at a fintech conference that was sponsored by USAID. Fintech, for everyone who's listening, is financial technologies or technologies that are used in the financing world, right, for doing some social good. And the reason why I wanted to talk with you is because you have kind of a unique story that's, I'm going to let you tell it. It's a unique story about bringing equity into the crowdfunding world. Let me not fumble over your story. Let's let you tell it first. How'd you get into this crowdfunding world in the first place? And, I'm interested in that Rose Garden story about kind of how it all came to fruition.
Sure. Yeah. I mean, it all started at a friend's wedding, actually. And before that was just, I've lived and worked in San Francisco in the kind of internet technology space on the business side. I'm not a programmer or a developer, but on the business side of things for about 15 years in a lot of different types of businesses. Some succeeded, some didn't. But over the course of that time, I was really lucky because I was able to get funding for my businesses because I lived in San Francisco, and that's where the money is, frankly. I grew up in a small town in Louisiana, and so I'm also very aware of what it's like to be in a place with no capital. Because I can assure you, where I grew up, there were the two banks, and there were a handful of rich people, and there's no other capital. Mm-hmm. And so that was it. And so, that's a situation that is very prevalent in most of the world. Obviously, there are a lot of people outside of the United States who assume that venture capital is plentiful across the country, but realistically, it's really only in about 4 or 5 cities in the U.S. And the rest of the United States, it looks very similar on the funding landscape as the rest of the world does. In the sense, there just isn't any. And that's because laws were written 80 years ago to govern how people could raise money for private businesses. Those laws were written back before there was a telephone in most people's house, a landline telephone in most people's homes. So, those laws made sense back then. They just don't make sense anymore. And so in 2010, at this friend's wedding, I and one of my very close friends and business partner, we Crowdfunding Capital Advisors, started talking about this. And we decided, maybe it's time to try to change the laws in the U.S. to enable people to invest in businesses they use every day and in entrepreneurs they believe in.
So whenever you go to weddings, you usually start talking about changing laws. Is that's your thing? No,
no, I guess it was a particularly nerdy corner of the reception that I found myself in, so it was one of those ideas that sounded like a good idea at 9 or 10 p.m. at the end of a reception, but at the next morning we actually kind of kept talking about it and talking about other people who all laughed at us and told us that was never going to happen because those laws were never going to change because it was impossible to change them. Every expert we talked to said there was no way it would ever change. Being entrepreneurs means, both of us were entrepreneurs, it means we're stubborn and not that bright because we couldn't get real jobs. And so we decided let's try to figure this out. So we did something a bit novel that I think helps in any of these kinds of situations. Instead of going to the government and asking for a solution, we created a solution and took it to the government and said, what do you think? We went with a solution, not with a problem. Mm-hmm. And so when you do that, what we discovered is people, regardless whether they agree or disagree, you've got something in front of them they have to react to. And with that reaction, whether it's positive or negative, you become a conversation, and then you have a chance to further the conversation with data and information and facts.
So what was the solution you brought? Did you bring a bill to them? Did you bring a platform where people were able to start crowdfunding equity, or what was that initial solution?
Yeah, I mean, we really just sort of said, look, if you can give away money on Kickstarter, if you can lend money to entrepreneurs in developing economies through Kiva, why can't you invest in businesses you use every day or in entrepreneurs you believe in? We, basically sat down at my dining room table with a computer screen, and on one side of the screen was a blank Word document. The other side was the legislation written in the 1930s. And we just said, okay, if we're going to update this into the laws of, into the way we live our lives in the age of Facebook and Twitter and Instagram, what would it look like? And so we created a 10-point framework. It wasn't like detailed legislative language because neither of us are lawyers, but it was a 10-point framework that policymakers could understand and the media could understand. And we took it to Washington and we started talking to anybody who would listen. And the key things we went to the SEC first. And the SEC said, look, this is a nice idea, good for you, tapped us on the head and thanked us. But they just said, look, we don't do this. You have to get a law changed. We're not going to do this. You're going to go to the Congress and have them pass a law, which was a great way to get rid of us. So we did. And interestingly enough, it was January of 2011 we started this work. And what we found is if you went to people's offices, senators and Congress people's offices, and you talked about job creation, innovation, and entrepreneurship, you got meetings. People wanted to listen about your ideas. Mm-hmm. People wanted to engage in conversation because, think back, that was during we were still dealing with the global financial crisis back then. And people in Washington was desperate to demonstrate they were doing something to create jobs and economic development in the U.S. So we had a lot of good timing and a lot of good luck. And over the course of a 460-day campaign, we were able to, have we testified in front of the House and Senate 5 times. We worked very closely, and gained the support of the White House and the Office of Science and Technology Policy. Our 10-point framework became the crowdfunding language in the Jobs Act. And, then it passed the Senate. And And then we were honored to be in the Rose Garden of the White House when President Obama signed the Jobs Act into law in April of 2012. So, it was 460 days, which as an entrepreneur is a lifetime, but from a government policy perspective, people seem to think it was pretty fast. So since then, obviously, when the laws passed, that's great, but as I'm sure most of your listeners know that we didn't know at the time, then it goes to the SEC for rulemaking. And so, the SEC then took its time working through the laws because it was a fundamental change in securities law. And the fundamental change was, it was like telling someone that the earth was round back in the 1200s. Because the fundamental law that changed was the ability for regular people to invest in private companies.
And so juxtapose that, what was the difference there that, I'm a regular person, I can go invest in Coke and Pepsi. But so what's the difference there? Like, why was that so fundamental?
The reason the law was put in place, back before the 1929 stock crash, what you had people going door to door, knocking on doors and selling fake stock and fake companies to unsuspecting people, to what they called unsophisticated investors. So they said, okay, unless you're really rich, which in the 1930s meant you had more than $1 million in liquid net worth, meaning excluding the value of your house, then you're a rich person and then you can do what you want. And $1 million in the 1930s was like, hundreds of millions of dollars today. Mm-hmm, mm-hmm. And, look, information was hard to come by. Information was very illiquid. You had to know someone and you had to drive to a place called a stock exchange to hand someone papers in exchange for cash, stock certificates. And so it's a very, hard to imagine. But today, the way information is very liquid on the internet, the way people can transact and travel very, very rapidly, it just didn't make sense anymore. And so, think about it. We've been trading public securities online through E-Trade and Schwab and other Vanguard, Fidelity for almost 20 years. The technology has evolved. And 20 years ago, we were told that regular people like us weren't smart enough to trade public securities online ourselves. So basically the big change is the ability, it just says that with the power of the internet, we have the ability to learn more about these small companies and startups and private companies, to evaluate them and decide whether or not we want to invest in them. Now, the thing that everyone needs to understand is that, making an investment in a startup or small business is a high risk investment, and that only a very small portion of your investable capital should be in high risk investments. One of the things that, wealthy people do is they diversify across many different types of investments, some very safe, some moderately safe, and some high risk. And so, people should think about this and work with whoever they talk to about their investments, make those decisions, because I am not an investment advisor nor a lawyer. These are the kinds of things that, we really just believed fundamentally that we needed to give everyone access to this. Because number one, we want to be able to unlock people's potential. I don't want everyone in the world to have to travel to San Francisco to try to raise money from Silicon Valley venture capitalists. I want people, in Nairobi, or people in Auckland, or people in Santiago, Chile, to be able to raise money themselves from their own communities, whether it be from wealthy people where they live or regular people where they live, using the internet, using this technology.
How has this fundamentally changed your life? As a person who was sitting on the Rose Garden, and it sounds to me like this is almost a bit altruistic, a venture for you and, your partner. Obviously, being able to say, you were sitting at the Rose Garden, you helped pass the law that puts you in an expert position that allows you to, one, obviously be on this show and other shows and give out that advice. But did you then use that platform to do some crowdfunding of equity, or is your whole game really being an equalizer and sort of spreading the gospel of crowdfunding?
So there's a bit of both. So when we were at the White House, the president had signed the bill, and we were talking with our main contact at the White House, standing there next to the Oval Office, and he just said, your lives are going to change, right? And we were like, nah, we're just going to go back and do our stuff. No big deal. It's just whatever. It's just this side project we had, whatever. But obviously that didn't happen. Obviously they did change. The trajectory of our lives radically changed. And it became a business. So Crowdfunding Capital Advisors is the business we formed after that work. And since that time, we've now worked in 40 countries around the world, all the 6 continents, really doing kind of 3 things. So one is we work with governments and policymakers and regulators on how to create policy and regulation to enable online fundraising in its various forms that is locally and culturally relevant and that works in the cultural context. Second, we've worked with financial technology innovators, so fintech startups, so to speak, in helping them to say, okay, here's what the policy looks like, here's what it's going to be, let us help you to create a successful business to take advantage of this market opportunity. And then third, we've worked with large, kind of transnational organizations like we've been honored to be a part of the State Department's Global Entrepreneurship Program, gone on 15 missions for the State Department to different countries to talk about fintech and entrepreneurship and crowdfunding. Going on my 16th mission to Ukraine later this year. And then also working with the World Bank on creating policy frameworks that developing economies can use in thinking about these things. And then working with large corporations and large financial institutions so they can understand this seismic shift. I mean, I think it's important for your listeners to understand a lot of times people think of crowdfunding as Kickstarter or Indiegogo, and they think of it as a cute way for people to raise money for gadgets. Mm-hmm. First of all, just so people know, there have been almost $3 billion raised on Kickstarter. So it's moved beyond the cute phase. And the other thing is that this will be the radical reshaping of the private capital markets. This is opening up and democratizing access to capital. People use that phrase a lot. And I mean, I want to be really specific. To me, what this is about is creating regulation that allows for innovation to offer products and services to people anywhere and everywhere. We've seen, the rise of e-wallets and mobile money and M-Pesa and different ways of making payments and transferring money between people. Those are all precursors to this sort of market development. Once you can allow people to move money around using all the technologies that people in your audience already have seen in their markets or heard of, those are pretty low trust kind of transactions because my money, moves in a way that I understand and it appears immediately. As people begin to trust the online transaction environment, they then are able to think about taking on transactions that require higher levels of trust. And so crowdfunding, I think it's also important for people to understand, crowdfunding does not begin with random strangers throwing money across the ocean at strangers because they think you've got a cute idea. In most countries with crowdfunding equity, it is 75% or so of the people who are investing in that business have either a first or second degree connection with that person on LinkedIn or some other social network.
I wanted to sort of break that down for a second. That
Sure.
I think there's still a fallacy out there of even the Kickstarter campaign for not equity but just cash, where you go create a campaign and if you've got a decent idea, you're going to raise $250,000, $500,000, exorbitant amount of money, right? Very quickly. Sure. Or you're going to be able to fund it. And what anyone who scratches beneath the surface quickly learns is that even the most successful, or actually the most successful campaigns, and even the ones that aren't very successful, there's an extraordinary amount of preparation, marketing, just campaigning. That's why they call it a Kickstarter campaign, right? Because it's a very intensive process of making sure that you show up with a win at the end of the day, right?
Absolutely. The thing I always tell people is raising money for a business is always difficult.
Absolutely.
This is just a new way to do a difficult thing. And that's just what it is. I mean, there's no easy way to raise money. But it allows you to more easily connect and scale those efforts. That's what's the difference.
And I think you're making a great point there because not, whether it's cash flow you're looking for through the sort of what we would call, inverted commas, a traditional crowdfunding campaign or equity funding, as you said just a few seconds ago, you're usually, if you're going to be successful with this, you've already built that momentum, right? You've built that buzz. You sort of, through the people that are connected to you or their close networks. And really, this is the platform. This is just a functionality that's going to allow you to gather all that in one place.
Think about it. It's like people used to have garage sales and sell stuff out of their, on.
What do you mean used to, man? Garage sales are still a big thing.
Of course they are. Of course they are. But they have now moved to eBay.
Right, exactly.
And they moved to Amazon. I'm just saying that, you used to have to go have dinner with a handful of rich people and beg for money. And while that activity may still be the case, what we're adding is the ability to have, this is, the ability to, instead of buying and selling, items, it's about buying and selling securities online. It's the same kind of a thing we used to do offline. It's now going to be online.
So let me turn the corner here. How does this change the universe for someone in the social sector? And specifically, we're probably talking about social enterprises here, simply because nonprofits and charities, they raise money in a different way. But, perhaps I'm wrong for a nonprofit, unless you've gone down that road somehow. But if I'm somebody sitting in the social sector who, they want to build a business that has a social outcome as well as a profit outcome, how do you think this changes the game for them?
Let me come at this a couple different directions.
Sure.
So one is from some news I saw today about that the current administration has decided to end, one of the initiatives around women and girls learning around the world. There were like $1 billion committed to it, and that's all been now stopped. So I think that people in the social sector, regardless of whether you're building a social enterprise that's going to have profit and good, or whether you are a traditional aid type of an organization that depends on grants and other sorts of, government or third-party funding, I think you have to fundamentally change how you assume your work will be funded or you will die. Because, whether it's through government action or through private action, the ways that people think about and evaluate funding these sorts of initiatives is changing rapidly. And so people who are trying to raise capital in the social sector need to adapt quickly. And so one very concrete example of that is a lot of larger social sector things used to be you'd have the annual fundraising drive, or you'd have the annual gala dinner or some large initiative where you could focus some energy and effort and raise the money for the year or a substantial portion of the year for your efforts, then go back to working on your efforts. I would suggest that, in addition to whatever those things are that they're doing, there needs to be some sort of other more tactical kinds of fundraising to really engage the network that you have. Because, people think about crowdfunding is it's not going to be successful in those sort of annual big picture, kind of efforts. Initially, where people need to be experimenting with crowdfunding, whether it's crowdfunding for equity in a social enterprise or crowdfunding for donations, is in small, very tactical campaigns. So meaning things like, instead of saying we're gonna raise $5 million for a new wing of the hospital, you should be thinking about, for crowdfunding, we're gonna raise $20,000 for 5 hospital beds. And so how can you because, number one, start small and start experimenting with these tools and start experimenting with the how of raising money online, because it's a very different experience, whether it's equity or donation. And also because people who engage in these campaigns through social networks typically like to feel very connected to the outcome and like to feel so it's not just this amorphous, united way, I'm giving money and hoping for the best that it all gets put to some good use, but like, I helped buy 5 hospital beds that are doing this in this country, in this place. And so, by starting with a small, very tangible, hands-on campaign, it allows the organization or the company to learn these tools, to experiment in a low-risk way, and to, achieve something small that they can then be successful at and then go on and create something, bigger in the next campaign.
One of the things that my bright brain keeps turning to, and I'd like for you to just emphasize from your experience, is that whenever I, either clients that we're working with or just, if it's a friendly conversation I'm having and people say, I'm going to go out and raise some money for this, or, I've got a company and I want to go find investors for this. The first thing I always say is you realize that's going to become your full-time job, right? Like that,
Yep.
That is what you do. Could you just sort of riff on that point for a second about when you make the decision as a company to start raising funds in this way or do a crowdfunding campaign of some sort, what's the effort like? What sort of energy and effort do you need to put behind it, and what kind of commitment does it entail?
It's a full-time job. Typically, what we recommend is if you decide that you want to do a crowdfunding campaign, it's typically about 3 months of work on a part to full-time basis preparing to launch. It can be as much as 12 months depending on the organization and the goal and all the other kind of variables at play. But typically, it's, the minimum is 3 months. And then the execution of the actual live campaign phase is also a full-time job, and that's typically between 30 days and 90 days at the outside. Typically, it's 30 to 60, and you need to be planning for a full-time effort to get it done because people are like, well, how could it possibly take that much time? I just make a video and put some words on a website and send some emails and a couple Facebook messages, and it all happens, right? Mm-hmm. Turns out that doesn't work. Turns out those are the campaigns that fail. And it's the campaigns that spend the time, like those campaigns that go really viral and raise hundreds of thousands of dollars or millions of dollars. And there's been a very small number. Those get all the attention. But I mean, the average Kickstarter campaign raises about $20,000.
That's a good fact.
But the ones that go viral or the ones that raise a lot of money, that wasn't by luck. That was through a tremendous amount of work and energy and discipline and tactics and some luck. And so those are the things I would say is like there was, just really kind of ground level example. There was a woman who was I spoke at the Global Entrepreneurship Summit at Stanford last year, and the woman on the panel with me had successfully raised in her first campaign, I think it was $1 million for a baby product.
So she was a rock star.
Yeah, right? She was a rock star. She raised $1 million. And of course, everyone was looking for the magic key to easily raising $1 million. And she spent her time on the panel talking about how there was no magic key. That, step one for her was, okay, who is every blogger and social media influencer and YouTube celebrity and, and local reporter that has ever talked about baby products in the last year, and put them into a spreadsheet. And then she put into another spreadsheet every single contact she could pull together from her contacts list and her phone and her email and an Outlook and Gmail, all of her WhatsApp and Facebook and Instagram and LinkedIn connections, and then started categorizing them by, how close she was to them. And then figuring out the different waves of communication that were going to go out to these different people at different points based on how much connectivity she had with them. Then started going and figuring out what are the live, real places where people gather to talk about baby products, where I can go, where she could go and begin to build relationships, real life, face-to-face relationships with those people so that in 6 months or 9 months after she had delivered value to them, she could then turn around and go, hey, by the way, I'm raising money for my company, this cool baby product, isn't this great? Trying to ask them for something. So there's a concept that she executed without knowing it. There's a gentleman who's been a very successful entrepreneur. He's built 2 businesses. One was a $60 million business. The other was a $100 million business. And almost all of it was built through online media, YouTube videos, and social media. He's written several books. His name's Gary Vaynerchuk.
Love Gary V.
Yeah. And so his whole concept of give, ask, or, jab, 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 right hook. And so you have to sort of do that of giving to a social network. Because if the first time someone hears from you that you went to high school with, and the first time they hear from you in 10 years is give me money, that's not going to happen. If you've spent some time, building that relationship, demonstrating expertise, demonstrating, what you are good at and why you are worthy of funding, whether it be an investment or a pre-purchase, then you have a better shot at doing that. So anyway, long answer to a short question, but there's a tremendous amount of disciplined, focused, tactical grunt work that is required to be successful at raising money for a business in every format, including crowdfunding.
I'm glad that you went into such detail about that, simply because, again, especially in the social sector, at least my 15 years of experience has shown me that is still one of those areas where you can walk into almost any NGO and you have that first conversation of, hey, so who does your fundraising? Or, how many proposals you put out this year? Or, what's your campaign strategy? And inevitably, 85-90% of the time, they're like, oh, well, we have a quarter-time person that does that, or something, or we do, as you said, we do the annual dinner thing or whatever, rather than looking at this as a true full-time position, not only a full-time position, but something that has a science behind it, that has a real, needs more than real effort. It's real art and it's real effort, and it's all the time.
So, the thing I would just say to people in this industry is that name one industry that has ignored the internet or fought the internet and won.
Mm-hmm.
Whether you were a neighborhood bookstore or a travel agency or traditional advertising agency and who thought this internet thing was not really going to affect you, they're all gone now. And so what I would say is that, you ignore this and you choose not to engage in this at your own risk.
Let's talk about for just a second the concept, of idea versus a product versus a service, and sort of the stage of where you might go out and start seeking funding, not only for equity, but maybe even just for cash flow. Through the many clients that you've worked with, is there a sweet spot in where you should start asking for money, or do you need to have basically something tangible you can put on the table for people, or is vapor enough?
Vapor is usually not enough. So typically what we see is that first place people tend to start is with Kickstarter. Kickstarter can be what Kickstarter is great if you have a product where you can, even if you've built a prototype, a working prototype that you can demonstrate in your video, and make a sales pitch for it. And basically what you're doing is you are pre-selling that product. So in the old days, you had a prototype, you took it to a bank or rich people and asked them to fund your first production run and then hoped you could sell it. The beauty of Kickstarter is that you can make a prototype and then put it out in the world and see if there's a customer. So this whole thing, people talk about product market fit, it allows you to test that with you having to spend much less cash, because making a prototype is much cheaper and easier than, producing 1,000 units and hoping they sell.
Mm-hmm.
That's a great place to start for a product-based business. For a business that already has a product and has sales and is looking to scale, so maybe I've had maybe one or two successful Kickstarter campaigns, or I'm a traditional business that's been just successful, but I need to be able to add a second location, right? I want to be able to expand my delivery network. I want to offer more services to my clients. Then you could consider either a debt campaign, like raising debt through the crowd, or you could do an equity campaign through the crowd. Because then what you're saying to them is, let's say I'm a dry cleaner and I have a great business at one location and I want to add a second location. Then I can go to my customers in my community, people who know me, who I'm engaged with on a daily basis, and say, look, I need to raise $100,000. I'm going to pay you 8% interest over the course of 5 years to raise the money so I can open that second location. That's a very viable strategy for doing that. If you are a tech business and you say, look, I don't have cash flow to support a debt payment right now, but I've proven that people want to buy my product, but I need to expand rapidly, or I've got a social media app that's really cool and I want to be able to do more things with it, then you can try to raise money through equity. What
are the equity pitfalls? I guess the first question I'd ask is, how complicated is it to set up? As you said, you were on the White House lawn in 2012. Like, how much has changed in the last 5-6 years here? Where, is it something that's really, click and play, where I can, sort of put together my prospectus and put it out there and bring people in, or do I need to have a set of lawyers and whatnot to be able to structure it so that I know how this equity is going to work? Let's start with that, and then I kind of want to get to the pitfalls of, the fears of, am I giving my company away kind of thing.
Sure. So the good news is that over the last few years, there's been a tremendous amount of infrastructure built in countries where equity crowdfunding is legal. There's been a tremendous amount of infrastructure built around this so that it's easier for companies to do this. So standardized legal documents, standardized approaches to accounting, standardized approaches to due diligence services. And these are products and services that are built to be offered in the crowdfunding arena to small businesses, because they're also offered online, so they can be offered at much lower cost than traditionally. So for example, in the United States, to do a private offering of securities, to get the legal documentation used to cost between $50,000 and $100,000 US. So very expensive.
That's a business killer in itself right there.
Exactly. So now there are services, one's called iDisclose in the United States that we're familiar with, that is able to deliver, and there are others as well, but they're able to deliver the same legal documents to raise money for between $3,000 and $5,000. And so it's just radically simplifying things. It's like when you used to have to pay $100 to trade stocks with your stockbroker, and then E-Trade came out and offered you that for $7.95. And so we're seeing the same kinds of things happening because we're just using technology to, reduce the amount of time and energy humans have to engage in something to make it work. So that's somewhat. So the infrastructure is coming into place. It's not all there yet, but it's coming into place. It's making it faster and easier for people to do.
So take me to that next step of, but when you go out and you're getting equity, these are people who are now investors in your company. You're kind of stuck with them for really the rest of your life, for the life of the company. What are some of the pitfalls there that people need to be aware of, or some of the gotchas, or basically, I'm looking for a best practice, bullet point or two from you about what should you do in this situation to do it right.
They say that when you get married, you can get divorced. When you have an investor, that's it. There's no.
It's not until death do us part, because it keeps going.
Right, exactly. So it's a very serious endeavor when you raise equity capital, and so I think that's where businesses need to think carefully, because if you are a business, because what an investor wants is not just to support you, but an investor wants their capital back, and they want it with an appreciation. And when people make high risk investments, they expect a high rate of return for that risk if it's successful. They know, or should know, that this is high risk and they could lose their entire investment. But if they get a return, they expect it to be significant. So as a social enterprise or a business, you need to think carefully about, okay, what is my return going to be to my investors? What will interest an investor? Not just, please give me money, but what am I going to give you in return for that money? Because it's an investment. And so that's why you need to think about do I need to create a bond that creates a steady stream of cash back to that investor so they get their capital back? Is this an equity investment? Am I going to have an IPO? Am I going to have a sale to a larger corporation, which will allow me to give a return on investment to my investors? So thinking about not just how much money you need and how to go get the money from investors, but then, because the next question the investor said, if the investor is interested in your business, his next question or her next question is going to be, what kind of return do you think I'm going to make on this investment? And so you need to have some answers for that. And you need to think about constructing the investment in a way that gives your investors the best chance you can. There's no guarantees, but the best chance you can of giving them a return. I think two other common things that come out in every talk I give, one is fraud and one is intellectual property. So I'll just handle those quick.
Okay. Mm-hmm.
So people tend to be like, internet, people are going to steal my money. It's fraud. It's going to be tons of fraud. So there's this general fear about that topic, but globally, if you look around the world at the countries where this is happening today, the instance of successfully committed fraud in crowdfunding is virtually zero. I mean, there've been, like I said, $3 billion plus raised on Kickstarter. I think there's been one case of successful fraud in Kickstarter, maybe two, right? So in almost every case, when there was a campaign that was going to try to commit fraud, because this campaign was online and you had people who could look at it, you had 1,000 pairs of eyes looking at it, not just one set of eyes looking at it. People spotted the inconsistencies. They spotted the things that were untrue, and they were able to report to Kickstarter, who then could take the campaign down. Mm-hmm. So it's much harder to commit fraud in broad daylight in the middle of, the public square than it is if someone's, sending you an email, offering you, something that's, one-to-one communication. This many-to-many communication that crowdfunding offers is actually an investor protection. Second thing is on intellectual property. People are like, what if someone's going to steal my idea by putting it online? So with that, I would just say, number one, speaking to audiences, if someone asks the question, and what I tend to ask is, does anyone have a specific example of someone who has stolen an idea and made it into a successful business? Mm-hmm. And typically, there's no one who can cite a specific example. Occasionally, there have been, okay? But 90% of the time, it's just this generalized fear people have, but no one can cite an example of where it actually happened. So the things I say in that regard is, number one, if you've cured cancer, then there's probably some intellectual property you need to protect. Or if you can turn lead into gold, then there's probably some intellectual property you need to protect. Most of the rest of businesses, it's much less about the IP and much more about the execution of the founders and the business owners. Because you are the only one who knows how to solve this problem your way, and your execution and your hard work has the best chance of succeeding. So obviously you don't put all of your information online for everyone to see, all your drawings and schematics and business plans, but there is a way to show enough to interest investors, and then in private communications, that happen with potential investors, you can have more, deeper conversation. So there's just ways of managing it so that it's you're not giving away your ideas to the universe.
I'm really glad that you brought those two pieces up because I love to often see my blind spots. You and I are entrepreneurs and we're kind of, it sounds like we're cut a little bit from the same cloth. The fraud piece never even crosses my mind, and somebody stealing my idea never crosses my mind. I've always just, you hit the ground running and the train leaves the station, and for somebody to catch up to you, it's just, it's next to impossible in so many ways. The questions I would ask you if we were sitting, in one of your seminars or one of your talks is, what about control? And what about exit opportunities? What do you have to say about, to people who are looking to bring equity into their company? That's often a thing, I'm going to have more investors, I'm going to be beholden to them, and maybe they're going to take control. I mean, it's the classic Steve Jobs situation, right? Where he built a company, then he was kicked out of it. And also, what are the exit opportunities for your equity investors?
So typically, IPO is always a possibility, but I think it's a very unlikely possibility because the regulations around IPOs are such that you need, in the U.S. at least, to be $1 billion plus company to afford to do it. And in most other countries, it's also quite difficult. There's a short-term opportunity and a medium-term opportunity in exiting the investment. The easier opportunity, relatively easier, is a strategic sale to a third party, right? So a larger company buys your business because they want to make it part of their bigger vision and their bigger dream. So that's the most likely outcome for most startups today. And that's a great outcome because you can exit it and deliver capital back to your investors. Mm-hmm. Mm-hmm. In the medium term, what is happening already, is we are creating these sort of semi-public markets for these kinds of securities. So as the hundreds of companies that have raised money this way become thousands and tens of thousands, it creates enough volume for almost like a public market to form. There are regulations that are coming into place to allow that. People will be able to trade these shares on a secondary market. And so that's also how investors over time will be able to exit these investments. But that's going to take at least 5 years for the market to mature to that point.
Last question I have for you, Jason, is essentially looking forward into the future. Obviously, you are one of the biggest cheerleaders for crowdfunding and for equity funding. What do you think the near term looks like in the next 2 to 5 years about how this continues to grow? What's the next big leap or the next big plateau that we're going to reach a milestone, I guess is a better word for it? And, is it basically sky's the limit, or do you see another game changer coming down the line that, I guess wouldn't replace this, but will disrupt it once again?
Give you a couple different things. So in the U.S. market, I would say that equity crowdfunding is on a rational and fairly slow start. And it's that way because that's how all of these different sort of funding mechanisms have started off. The first 24 to 36 months, it's a steady, gradual growth of the market because these are new financing tools from new issuers to new investors using new technology. So people tend to move, that much new has happened, and they tend to move a little slowly. But when you look at Kickstarter and other sorts of platforms, after 2 to 3 years, the curve bends and you get much more rapid acceleration in the utilization of the tools because there have been some successes. People understand it. The infrastructure has been built around it. It makes sense. So that's one thing I think we'll have in the U.S. In developing economies, I think, the work that we've done in Asia and Latin America, I think we're certainly going to see more countries in those regions legalize equity crowdfunding, obviously Thailand, Malaysia, Singapore, Vietnam. There have been some work that's being started that's thinking about this from an ASEAN-wide perspective, which I think is very wise. We've also done some work in Latin America thinking about, from a Latin American-wide perspective, how do you enable cross-border investment, cross-border capital flows, diaspora investment? All these things are, at the top of people's minds in the development community. And so what we need is we need to have the tools, the financial tools, and the regulation to enable these new technologies to really reach their full potential. And so I think that that's the thing for me is the next phase is this moves from early adopters to mainstream utilization, and then the regulation keeps up to enable the cross-border flows and the diaspora investment that I think people in your audience are really going to benefit from greatly.
Jason, I'm happy to say with most guests on this show, I could sit here and talk to you for the next 3 hours about this. I know your time is short today, but thank you so much for giving us the overview about equity funding today, and maybe we'll be able to circle back at a later time.
Would love to continue the conversation, Stephen. Thank you so much for the time today.
Hey there. Thanks for listening to the show. If you liked what you heard, if you found value, could you please give us a rating? Obviously, I'd love to see 5 stars, but give an honest rating. And if it's important material for you, share it with your community. Tweet it, put it on Facebook, but help spread the word about Terms of Reference Podcast. Thanks. You've been listening to the Terms of Reference Podcast from Aidpreneur.com. Subscribe to us on iTunes.